Warren Buffett is worth over 130 billion, and he has told ordinary people repeatedly for decades exactly what to invest in. Most people hear it, nod, and then ignore it completely. That decision cost them hundreds of thousands of dollars over a lifetime. Today, you are going to understand what Buffett actually recommends, why it works mathematically, and exactly how to start, even if you have never invested a single dollar. Let's get into it. Section 1, the problem. Here is what most beginners actually do. They open a brokerage account, watch a few YouTube videos about hot stocks, maybe buy some Tesla or a random penny stock their coworker mentioned. They check the price 17 times a day. They panic when it drops 10%. They sell, they lose money. Then they decide investing is not for them. According to Dalbar's 2023 Quantitative Analysis of Investor Behavior, the average individual investor earned just 3.9% annually over the last 30 years. The S&P 500 returned 10.7% over that same period. That gap is not a coincidence. It is the result of emotional decisions, stock-picking guesses, and chasing returns that have already happened. Let's put real numbers on this. If you invested $10,000 and earned 3.9% annually for 30 years, you would end up with roughly $31,000. If you had simply earned the market average of 10.7%, that same $10,000 becomes $203,000. That is a $172,000 difference from one decision made at the beginning. The problem is not that people are lazy. The problem is that nobody teaches the foundational rule. People try to beat the market before they even understand what the market is. They overcomplicate something that Buffett, the greatest investor alive, has kept deliberately simple. Section 2, the truth. So what does Buffett actually say? This is not speculation. He has stated it in shareholder letters, CNBC interviews, and in his own will. In his 2013 letter to Berkshire Hathaway shareholders, Buffett wrote this, and this is a direct quote. "My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I believe the trust's long-term results from this policy will be superior to those attained by most investors." Read that again. The man who has spent 60 years studying individual companies, reading financial statements for hours every day, and beating Wall Street professionals at their own game. His advice to beginners is buy a low-cost S&P 500 index fund. Why does this work? Here's the mechanism. An S&P 500 index fund holds shares in 500 of the largest companies in America: Apple, Microsoft, Amazon, Nvidia, JP Morgan, all in one single investment. When you buy one share of an index fund, you own a tiny slice of all of them. When one company struggles, the others carry the weight. When the American economy grows, you grow with it. According to S&P Global, over any 15-year rolling period since 1926, the S&P 500 has never produced a negative return. Not once. Time in the market is the engine. Compound interest is the fuel. Buffett has also been razor sharp about costs. The enemy of returns is fees. Actively managed funds, the ones where Wall Street professionals try to pick winners, charge 1% to 2% in annual fees. A Vanguard or Fidelity S&P 500 index fund charges as little as 0.03%. That difference sounds small. Over 30 years, it can consume 20% to 30% of your entire portfolio value. Buffett calls high fees a wealth transfer, from you to the fund manager. The truth is that simplicity is not a consolation prize for beginners. It is the actual optimal strategy. Section 3, the framework. Here is a 5-step system you can implement this week. Step 1, open the right account. If your employer offers a 401k with any match at all, start there. A 401k match is an instant 50% to 100% return on your contribution. No investment in the world guarantees that. Contribute at least enough to capture the full match. If you do not have a 401k, open a Roth IRA. In 2025, you can contribute up to $7,000 per year. A Roth IRA grows tax-free. Every dollar of profit you make inside it, you keep. Step 2, choose a low-cost S&P 500 index fund. Three options dominate. VOO from Vanguard, with an expense ratio of 0.03%, from Fidelity at 0.015%, and IVV from iShares at 0.03%. Any of these three will get you direct exposure to the S&P 500 at almost zero cost. Pick one. You do not need all three. They all track the same index. Step 3. Automate your contributions. Do not rely on willpower. Set up an automatic monthly transfer the day after your paycheck hits. Automate 100, 300, 500, whatever your budget allows. The behavior of investing consistently matters more than the amount at the beginning. This strategy is called dollar cost averaging. You buy more shares when prices are low and fewer when prices are high. You eliminate the emotional decision entirely. Step 4. Do not touch it. This is the hardest step for most people. Markets will drop 20%, 30%, even 40%. In 2020, the S&P 500 fell 34% in 33 days. It fully recovered in 5 months. The people who sold locked in a loss. The people who held or kept buying made a fortune on the recovery. Step 5. Increase your contribution rate by 1% every year. Every time you get a raise, direct half of it into your index fund. This one habit, applied consistently, can double your ending wealth over a 30-year career. Section 4. Real-world example. Let's make this concrete with real numbers. Scenario 1. You are starting with $10,000 today and adding $300 per month. You invest in an S&P 500 index fund averaging a conservative 9% annual return. After 30 years, you have approximately $680,000. You personally contributed around $118,000. The remaining $562,000 was built by compound interest, the market doing the work for you. Scenario 2. You have $50,000 to invest right now, but maybe from an inheritance, a home sale, or years of savings sitting in a low-yield account. You invested in VOO, add $500 per month, and leave it for 25 years at 9% annual return. You end up with approximately $1.1 million. Your total contributions were roughly $200,000. The market delivered the other $900,000. Scenario 3. You are starting late. You're 45 years old with $100,000 saved. You contribute $1,000 per month for the next 20 years into an index fund at 9% average annual return. You retire at 60 with approximately $1.3 million. Even a late start with consistent action produces generational wealth. Now compare those numbers to the average savings account in America. According to the FDIC, the national average savings account interest rate is 0.46% as of 2024. That same $10,000 sitting in a savings account for 30 years becomes $11,500. You lose the purchasing power of decades of inflation on top of that. Buffett has said it plainly. The real risk is not that the stock market will go down. The real risk is holding cash while inflation quietly destroys your purchasing power. Doing nothing is the most expensive choice most people make. The math does not require genius. It requires patience and consistency. That is it. Outro. Key takeaways. Let's lock in what you just learned. First, the average investor dramatically underperforms the market because of emotional decisions in stock picking, not because investing is hard. The gap between 3.9% and 10.7% annually represents hundreds of thousands of dollars over a lifetime. Second, Warren Buffett's advice to beginners is not complicated. Buy a low-cost S&P 500 index fund. Keep fees under 0.1%. Stay invested. Let time and compound interest do the heavy lifting, because no professional stock picker reliably beats the index over decades. Third, the system works when you automate it. Open a Roth IRA or max your 401k match. Choose VOO, SQUAKES, or IVV. Set automatic monthly contributions and increase your rate by 1% every year. That is the entire playbook. The information has always been available. Buffett has been shouting it for 40 years. The people who act on it build wealth. The people who wait for the perfect moment or the perfect stock tip stay exactly where they are. If this video gave you clarity, subscribe. New wealth-building content drops every week built around real data and real tactics, not hype. Drop a comment below with your biggest financial goal right now. Reading every single one.